Okay, I want us to go into risks, understanding understanding the business and materiality. So this one was given to us by ISA 250, the Internal Standard of Auditing 250. We have the one of 315 and 320. It will also understanding the entity and its environment. So according to ISA 315, it requires understanding the entity and its environment to identify and assess risks of material misstatements. Key considerations include the industry, management competence, internal control system, financial performance, reporting requirements, and recent developments. So now there's no how you, as an auditor, as a professional, that you discharge your duty effectively without going through understanding the business and the materiality of the entity in which you are going to. So the standard has made it clear on what the auditor is expected to do. According to the standard, you need to have a basic understanding of all this, which is the industry in which the entity operates, the nature and competence of its management, the entity's internal control system, the its current financial performance, reporting requirements and deadlines, and recent developments. So all these things are very vital for the auditor. And why is it very vital? Like I said earlier, this enables you to have stamina as an auditor. It enables you to understand the inherent risks involved in any organization you find yourself, because the risks in an oil and gas in the company is different from the risks in a banking industry. Are you get what I'm saying? So if you don't take your time to understand the nature of the business, the industry, the internal control system put in place, and some other things, you end up mixing up things. And in the long run, you end up messing up the work you've gone there to do. So that is why it's important that you do due diligence for this. So now, what is next for us? What is next for us? We need to understand the accounting and internal control system of the organization. So, what is an internal control system? At our basic level, we are taught about internal control. Can anybody tell me what he or she understood by internal control system? The one they taught us at our early stage of audit. If you are, what do you understand by internal control? If you are, okay, Shola.
Internal control system is like a measure or a procedure put in place for a particular organization.
Okay, fine. So they equally call it a whole system of control, a whole system of control, which is could be financial or otherwise, which is established by the management. Are you getting me? To ensure that the organization don't lose its assets, whatsoever thing that is valuable to the organization. Are you getting what I'm saying? So it's cool. So now in the auditor now carrying out, okay, where am I? Okay, in the course of the audit now, the auditor will now ensure that he uses best judgment to ascertain and to understand the internal controls which is relevant to his audit. Are you getting me? Fine. So now, what are the internal controls that the auditor? It's not is a case by case basis. That's the internal control that were adopted by a company A might be different from the internal control system that will be adopted by company B, because they have different scenarios, they have different products, they have different services, and they operate in different. They might be operating in different industry. Are you get what I'm saying? So now, they said in order to make a decision about the amount of testing that should be carried out in the audit, the auditor should consider his previous knowledge of the client company, any recent changes, any known problem in the internal control of the client, The effect of any new auditing or accounting requirements. The auditor's assessment of the entity's internal control system is dealt with in more detail. So we'll still get there. So this is just about understanding the client's business and materiality. Are you getting me? So it's just to understand. There's nothing much about it, please. So it's understanding. Then we have risks and materiality. Risks and materiality. So what is risks and why is risks and materiality very important in the course of the audit? We are still on to ISA 315, which requires to identify and assess the risks of material misstatement at both the financial statement and the assertion level. At both the financial statement and the assertion level. So the financial statement level refers to the risks which are pervasive to the financial statement as a whole and which potentially affect many assertions. An example might be if management have a tendency to override internal controls. This will affect
I
do you understand it?
no.
You don't understand, right?
Yes.
Okay. What they are telling us is that we are talking about risks and materiality. So now everything the auditor is doing revolves around the financial statement. So in the auditor needs to watch out for the risks that tends to emanate even from the management. I don't know, maybe you understand, that has been recorded in the financial statement. So now there are times whereby, let me give you an instance. In this, I told you, we all know what they call standard operating procedures. Are you getting me? About it's for a company's internal use that guides their operations and that guides their activities, right? So now in the policy, they might say, okay, before the auditor issue out, maybe no, they might say before the accountant issue out 50,000 naira, so person must sign. Are you getting what I'm saying? Or before the accountant issue out 1 million naira, so person must sign. But on this particular occasion, the accountant issued out 1 million naira and the person did not sign. Somebody else went to sign. Hello, can you hear me?
Yes, I can.
Okay, okay. So this kind of it's kind of a risk. So the auditor will want to know why and what happened, what led to circumstance, because it's like somebody has override controls. Somebody tried to circumvent or bypass. You didn't follow the right channel of getting things done. So the auditor need to have a skeptical mind of an inquiring mind of asking what happened. So you need to dig deep. So now the second one, they say the assertion level refers to specific objective of the financial statement. For example, that all liabilities have been recorded and that recorded asset exists. So this aspect now, to mitigate the risks when the auditor is actually going through the records or books of account as well, when he confirms the physical asset, it needs to be corroborated with what is written down in the books or in the record or asset register. But where he discovered that some items were in the books but were not physically present, it means that maybe they pilfered them or they have been stolen, right? Or you can discover that some assets were physically present, but they were not recorded, they were not captured. So the auditor will still need to ask questions. So all these kind of things could increase the level of assertion of the auditor. So that is why the auditor needs to do due diligence in taking up all these records. So any question on this?
Mm,
Any question? No question, right?
yes.
Okay, fine. So now we want to talk about the audit risk approach, which was developed in the 1980s. The previous approach, including the following: the substantive approach, which includes where every item in the financial statement is tested and vouched to supporting documents. So this one, the what they do previously is that you must make sure that every kobo, everything that was written, that was captured in the financial statement, you must test them. You must make sure that they exist, or you must make sure that they actually, if you say you buy an item of 5 naira, there should be an invoice or there should be a receipt that shows that you actually buy that thing, right? If you say you give somebody so thing, there must be an evidence of collection. So everything you're doing, there must be somewhere something to trace back to. So there must be an evidence for it, and that is what they call substantive approach, which was used previously. Then we have another system called the system approach. So this one was developed to avoid over auditing. So it's not about working hard now; it's about working smart, isn't it? So because of the advent in technology, a lot of things has changed. Transformation of things and the way things are being done, and the sophisticated nature of most transactions and complexity of some organization. So you need to really adopt a more system-based approach to auditing. So they say this one was now developed to avoid the old style of trying to check everything into two. So this is it. So they now say the underlying accounting system we are tested with less emphasis on testing on of individual transaction and balances. However, this approach could still lead to over auditing as systems covering low risks or immaterial areas were also tested. So now, most firms now use a mixture of audit risk approach and system-based approach. Even though they give us an alternative, which is the system approach, they still give us instances where you can still over audit or you can still meet challenges of trying to audit more, where you realize that some particular transaction has high risks. You have the tendency of trying to count them one after the other, even though it's going to take you months. You want to count them to really verify what is really happening in them. Let me give you an instance. I have a basic understanding about bank a bit. Can you hear me? um there was this day, I used to work in a bank. There was this day an external auditor came to the branch. Can you all hear me?
Yes.
Okay. This external auditor, they call them RCO. So they came to our branch uninformed when they came to their branch. So the first thing they used to target is the ATM and your vault. So they mostly come before every other staff. So when they come, they ensure that the custodian of the vault and the custodian of the ATM will not have access to the ATM before they go inside. Are you getting what I'm saying? So now what they now do is they want to really be sure that, because cash is an high risk in the banking industry, is susceptible to pilfering and whatsoever thing. So now this particular day, the auditor now came into our vote. When he entered the vote, he was now doing a random count of we have stack, we have bundle, we have packets in money. That's the way money is being arranged. So this day, just look at the bundle that was kept. He now checked. Out of the bundle, he now removed. He now discovered that he saw a packet in it that looks as if something has really, they've removed some pieces out of it. He was not convinced. He now gave one of us to confirm. Lo and behold, when we confirmed this morning, truly, instead of 100 pieces, it was about 87 pieces thereabout. Are you getting what I'm saying? Now, do you know what the man did? He now said they should evacuate all the money out of the vote. Those denominations, they should evacuate all the money. Now, he now said they should bring counting machine. He now engage someone to ensure that they confirm the money, so that he knows that all the cash in that vote is complete. Because his assertion now is that hmm, if if about 13 pieces can be missing from a packet, just one packet, so it means that other packet too might have similar challenges. Are you getting what I'm saying? So now, I didn't mean he picked the first second and he didn't find anything. He will have assumed that everything is fine. But because the first one he picked informed his decision, So it turned out to be something else. So that is how an auditor works. So something that you felt it can take you a day, sometimes it could take you 6 months because you now do over auditing. That's what they really do here. So because of the risks involved in it. So we are talking about materiality as well in IS 320. What is materiality? Materiality is what we already know. It's also treated in financial reporting. So yeah, what are they telling us about materiality? They said if its omission or misstatement could influence the economic decision of users taken on the basis of the financial statement, then that thing is what is material, that is significant. So in the course of you planning and performing your audit, so what does it require of you? Auditor are entitled to assume that users have a reasonable knowledge of business and are willing to study the information in the financial statement diligently, understand the financial statement, are prepared and audited to levels of materiality, recognize the uncertainties inherent in certain amounts in the financial statement, such as provision, should make reasonable economic decisions based on the information in the financial statement. It equally requires the auditor to apply the concept of materiality when planning and performing the audit and when evaluating the effect of misstatement of the financial statement. So this one is just still like what we're saying now is about discovering some things in the financial statement. Some things that there are some aspects of the financial statement that you cannot overlook. You just have to pay keen attention to them. You pay attention to every details coming your way because those areas could be high risk. So when you know that those areas could be high risk and they have inherent tendency of hiding or disguising some things, you need to painstaking and do due diligence in taking your records. Any question? Any question, please?
No.
No question. Okay, let's continue. Uh, So now let's go to setting materiality. So okay, let's be practical about this one now. I told you about I gave you an example about my bank, my previous bank, right? Now I didn't mean the auditor now count a cash in the course of that audit. I now discover that one pack missed one pieces. Abi, he can decide to overlook it. But if he discover that one pack means a whole five, he might not overlook it. Now, depending on the threshold they set, so each organization have level of they have qualitative or quantitative threshold that has been set for materiality because they know that no system is perfect, no system is 100%. So there must be an iota of mistakes or there must be iota of um, misrepresentation or misinformation somehow. So what do they do now? What they do is they use a metric like they can say profit before tax. Let me say this. So this let's know materiality levels. So let's assume that we want to use this following as KPI as our performance metrics: profit before tax, revenue, equity, total assets. We can use other things, so we can even use cost of goods sold. Are you getting what I'm saying? So it's not just limited to these ones, but it's just an example. So we can now create a benchmark. So the benchmark now can be you can say under profit before tax. Under profit before tax now, the benchmark you said should be maybe 10%. Then revenue, you can say 3%. Equity, you can say 2%. Total assets, you can say 8%. So what it means is that any any error, hello, can you hear me?
Yes.
Any error made above, assuming that this profit before tax eh, is, let's say 1 million naira, let's say 1 million, Abi, let's say this is revenue should be greater. Let's say revenue is 50 million, 50 million. Then equity, let's say your equity is 1 million, 1 million ordinary shares. Then your total worth of the company, let's say 100 million. Are you getting what I'm saying? So now what it implies that your profit before, let me clean this one. Okay, this one is just, let's say 1%. 1%. Okay. What this means that, let me expand it. So 1% of 1 million is how much? 1% of 1 million is what? 1% of 1 million is what? 100,000, Abi? 100.
100,000.
All right. So 3% of 50 million is what? When I play punch calculator, 3% of 50 million is what?
1,500,000. 15 million.
50 million, right?
It's 15 million.
Okay, the next one, 2% of 1 million.
No, 50 15 million. 3% of 50 million is 1,500,000.
I didn't get you. You said what?
3% of 50 million is 1,500,000.
Okay. What about 2% of 1 million? Is 200,000, I think.
Yes.
And 8% of 100 million. So don't worry. Leave this one to give it just 1% to 1% of 100 million. 1% of 100 million is how much? 1 million.
1 million.
Okay. So what this thing means is that
Yeah.
when you have an error of 1 million naira on profit before tax, hmm, is within the materiality threshold. Are you getting me? Is within the threshold. Within the threshold. Did you get that? All this one, any error, any amount that you discovered in error, that is, maybe you are now auditing your revenue for the company, right? And now you discover that there's um an amount that you cannot account for about 1.5 million naira, hmm, is within the threshold. Are you getting what I'm saying? But the moment it's now 1,501,000 kobo, or one, as long as it's more than. then it means that additional audit is required for it. Additional validation. That's you need to re-audit it, you need to reconfirm it. Be sure that what you saw is the real thing. Are you get what I'm saying? So if you enter anything you get here, it's just an example. 1 million naira is an acceptable level of error, but anything that surpass 1 million naira for first before tax is not allowed. So likewise for revenue, 1.5 is allowed. Anything that surpass 1.5 is not allowed. But if it is 200,000 is allowed for acceptable level of error.
What
But
if
anything that
it's less
surpass it
than?
is not allowed.
What if it's less than?
Yes, that's why I didn't say less because I'm talking about it can be within, it can be 1 naira, it can be two, but it should not be more than. Are you getting it? Just that they put a peg to it that it should not be more than. So if it surpassed it, then it is not allowed because they know that no system is perfect. So they give room for mistakes. That is just the implication. Any question? Any question on it?
No.
Okay. So let's go ahead. All right. So there's an example of materiality here. They say the materiality level for inventory valuation may be set at, like, just what I did here. I've given us the what do you call it? The example. Then pre-tax. Do we do this one or we understand it? Should we do it?
You should do it.
This all right, fine. Okay. Illustration on materiality. So what is it telling us? They say draft financial statement for XYZ shows the following. So they say the revenue is 100 million, Abi. Pre-tax is 8 million. Inventory is 4 million. Trade payable is 4 million. So now they say materiality for the financial statement as a whole. So now look at what they told us now. For let's put it here. These are the benchmark or metrics. These are the metrics. We have the revenue. We have the pre-tax profit or profit before tax. We have inventory. We have trade payables. So this one now for revenue we have 100 million. We have 8 million. We have inventory 4 million. We have this one is 3 million. So now they said what is the this thing benchmark, benchmark now for revenue.
No.
Okay, if there's no question, I think on this note we can call it a day, right? We can call it a day. So good night.